Hey guys, welcome to today's session. It feels like forever since I've been on stream, and I'll explain why in a moment. I'll give everybody a minute to join. I've just pinged the Discord. I'm sure you've all missed me and my awful Brummie accent, but we're back. We're going to jump straight back in. I feel like we've got a hell of a lot to catch up on because the market's been going nuts. I've been super busy. I was actually I was over in Madrid last week at the Darwinex head office, hence why I was a little bit quiet and couldn't get to my normal streams. The issue is when I go over to Madrid, I don't have my PC. I just have my laptop with me, and it's always a little bit more difficult to get peace and quiet, get somewhere that I can just jump on and do a stream, and it's always just, throws me off my routine and stuff. I'm going to start the stream and tell you exactly why I was in Madrid, which is, for a lot of you who've been around Darwinex for a long, long time, it's a bit of a shame. But Ignacio has left Darwinex. He has done so for personal reasons. He had a few things going on in his personal life and got offered a really, really great position at a different company over in Spain. And therefore, he's had to step away. However, he is still a shareholder in Darwinex. He still has a vested interest, and he is still active here in the company. He built Darwinex for the past 12 years, and he has, been a huge, huge part of the company and who we are and our ethos and everything that Darwinex stands for. But of course, being so close with Ignacio, it wouldn't have been right me not being over in Madrid for his last day. So I was over in Madrid for that reason specifically, hence why, again, last week was a bit of a write-off. But we are back to regular, what's the word? Regular program schedule? I don't even know what I'm trying to say. Regular scheduled programming. Whatever I mean by that. I don't know. But welcome, guys. I can see more and more people are joining the session. It's a pleasure to be back. It feels really, really good. I've had some time to reflect over the past couple of weeks whilst I haven't been streaming as much. And kind of thinking about how we can make the most of these sessions. And what I would really like to do is start to bring some of you guys into these sessions, specifically if you are a Darwinex trader. I would love to get some people on, host roundtable discussions, just have a chat, watch markets, watch news events, and make them a little bit more interactive. PX Lou, welcome back. How are we doing? Because at the minute, these sessions are, just me speaking to you guys for an hour or so. I think it would be way more entertaining and a way better use of everybody's time if we have some of our, top traders coming on, sharing insights, sharing thoughts, and watching the markets together. So this has been in the works for a long time. I'm sure, people who've been coming to these sessions regularly will remember me talking about Darwinex TV a long, long time ago. But it's something that I've been working on and really trying to get the formula ready, I suppose. One of the things I will say is some of the trading talent that we've had come through Darwinex Zero over the past year, but especially over the past few months, has just been absolutely insane. Like, I am seeing some just killers come through Darwinex Zero. And the performance that we're seeing from them is incredible. Even when the market gets a little bit more volatile and a little bit harder to trade, there's just people out there who are consistently day in, day out smashing it. And it'd be really, really great to get some of those traders onto these sessions, have a chat, and just share some of the insights that they have. Because I appreciate, trading for everybody isn't always sunshine and rainbows. There's, especially when you go on social media and you see that other traders might be killing it, or at least it seems like they're killing it, and you might have been, on a big losing streak. And it's always refreshing to hear from traders, who are in a different boat to you, who might be doing well when you're not doing so well, or vice versa. When you're doing really well, you can provide value to those, that might be going through a bit of a rut. PX Lou, have been quite inactive on here. You kind of inspired me to finally pursue my goal of switching to algo trading. So all of my focus was put on there. Love that, dude. I mean, you haven't missed much because I've also been inactive. So the past couple of weeks, we haven't done many live streams. I don't know if you was in here when I started talking about it, but I was in Madrid last week. So last week was, pretty much a write-off. And then for the guys who I've been coming to these sessions for the past few weeks, you'll know I was having issues with my chest. I had something called costochondritis, whatever that means. But it's basically the cartilage around your sternum, around your chest gets inflamed, and it feels like you're having a heart attack 24/7. So it was absolutely diabolical. And the last thing I wanted to do was come on and speak, because it was just hurting to talk. So the past couple of weeks have been a little bit, not kind of here nor there, but we're back at it, and we're back to normal now. I appreciate that, PX Lou. I appreciate that big time. Okay, so let's talk markets because let's face it, last week was one of the nastiest moves I've seen in a long time, especially in crypto. And whilst there have been worse moves, in history, risk 1%, how are we doing? Howdy, partner. Because let's face it, there's been worse moves over over the past in crypto, 2 years, 5 years, 10 years. But it sometimes is less about the move and more about the violence of it. So if you were watching altcoins, they just got absolutely smashed, and traders were getting or buyers were getting quoted way down the book. I can't remember off the top of my head, but I think it was XRP was getting quoted for sub $1, if not sub 50 cents. And it just goes to show you how irrational the markets can be at the drop of a hat. There's so much leverage, and this is what a lot of people, especially newer traders, don't quite understand, is the market is essentially this machine to generate leverage, right? The same way as when you buy a house, you're not actually buying the house, you're just buying the leverage to buy the house, right? So if you wiped out all of the leverage in the housing market, the property prices would absolutely, just cake it to the floor, because there's no leverage propping up the market. Sai, how are we doing? And it's the same with crypto. It's the same with the S&P. It's the same with all of these assets. Currency is a little bit different, but a lot of leverage goes into these assets, and especially in crypto, where the available liquidity is a lot less, and the ratio of leverage to liquidity is again a lot less. You tend to get these wipeouts. Now we have them every 6 to 12 months, every couple of years, we have a big one. And basically what we tend to see is, and it's really sad, is kind of life-changing, a life-changing crash, let's say. And even though, if we look at Bitcoin on the daily, right? At least my support held. If we look at Bitcoin on the daily, so top to bottom, let's take a look at the size of that candle. I mean, that's a 17% daily candle, 17% move in a day of an asset that has a market cap of a couple of trillion, right? Is that right? A couple of trillion? I think so, off the top of my head. Again, I don't know off the top of my head. It might be higher than that now. That's a lot of value to be wiped. Now, in fact, let me bring it up, because it'll make more sense to actually know the value, right? Okay, so 2.2 trillion. Oh, didn't mean to do that. So we go 2.2 trillion. We're just doing this, not doing this like proper maths. 22 million, 200 million, 2 billion, 22 billion, 220 billion, 2.2 trillion. Okay, so 2.37. I'm not retyping that out. Let's just say 2.2 trillion. Okay. And then we say there was a 17% move. So if we times by 0.17, it's basically saying there was $374 billion of market cap being wiped off. Now, that's not $374 billion of money in people's pockets, but that's $374 billion worth of leverage. So the same way that you would get leverage in an FX broker, you get the same in crypto, although it's a little bit of a different beast. But essentially, you might have $1 million, but your position might be $10 million, $15 million. Again, what a lot of people don't realize is you can actually go into negative equity with these brokers or these exchanges. If you don't have enough money to post margin, well, guess what? They're not closing. Well, some of them will close positions, but you can if the slippage is that bad, if a move is this violent, you can end up owing these exchanges or owing these brokers money because you don't have enough funds in your account to sustain the position. And again, like I say, it's not life changing for somebody. You know, if you bought spot Bitcoin up here, 122K, and then it tanks down to 102K. Let's say you bought one full Bitcoin, you've lost 20 grand, okay, in a day. Not nice. It's about a sixth of your asset value, a sixth of your investment, or yeah, about a sixth. So, you know, 15% or so. But it's not necessarily life changing. But if you're leveraged up, okay, if you're leveraged up to the absolute nutsack, and this move, let's say your stop or your liquidation price is somewhere down here or somewhere down here, or let's say you've been on crypto Twitter or FinTwit and you see some idiot influencer who says, "Oh, we're never going to see $108 Bitcoin ever again, yada yada yada." You set a pending order here with your stop loss or your liquidation price somewhere down here so that you feel like you're protected. When that comes blasting through there, you best believe that you're getting liquidated and you're absolutely out of the market. So playing with leverage is just a different beast to you know, spot trading or spot investing. Again, there's differences with trading crypto as there is trading FX when it comes to leverage, but we won't get too much into those details now. But the message that goes out to all of you from me is I've been in crypto now since 2017. I always get mixed up, 2016 or 2017. I've seen a lot of these crashes. I've seen worse ones than this, you know, candle size wise. This felt a little bit artificial and a little bit like everybody should have known this was coming but didn't, and just got absolutely shafted. But if you've been affected by this, just know it gets better. The best thing to do is to take a step back from the markets for a period of time, however long it takes to kind of feel normal again when you look at a chart, because believe me, I've been caught up with moves like that in the past. I've lost lots and lots of money in the crypto space, and I know how it can feel. So take some time, recuperate, and, you know, just come back stronger. Come back when things are a little bit more clear and you don't have that emotional tie to the chart or to your money, or the money that you lost again. We, you know, at Darwinex, we primarily don't focus on crypto investing, of course. So, you know, it might not have affected many of you, but if there's even one person who's watching this who got hit by that and lost a lot of money, or you know, to them lost what they feel like was a lot of money, please just know it gets better. But just do the right thing, take a step back, and let time heal all wounds, because that's what it does. Now, I don't really want to go over the presentations. I am kind of done with those, the presentations that we used to do, the welcome sessions, the risk engine stuff. And so I just want to keep these sessions lighthearted, keep these sessions a bit of fun, take a look at some markets, you know, actually provide some value to you guys, and you know, see what we can come up with. Like I say, for the guys who weren't here since the beginning, how we doing, Tale? It's good to have you back, dude. For the people who, I'll show you XAQP in a moment. For the people who weren't at the start of the session, I would love to start doing some like roundtable discussions, bringing on our traders, and just again making these sessions a little bit more entertaining, bring a little bit more value. I'm always conscious people message me and they're like, "Love the live stream, took so much value away from what you was talking about." But for me, I'm kind of like sometimes thinking, I'm actually giving people value. I don't know. Sometimes it doesn't feel that way. To answer Tails' question, so XAQP. So there was an issue the other day. Okay, so the actual account doesn't look too bad. Had my ass handed to me to start this week, which is never fun, but it is what it is. There was an issue with the liquidity provider not quoting silver last week on Thursday night, sorry, and then Sunday. And so I actually got hit, ready to rob a bank whenever you get into gold. Yeah, I mean, I feel that too. I'm gonna start shifting some capital into XAQP once it's live. but we had to basically go back and take a review of my Darwin, because my Darwin, there was like a glitch because of the silver quotes that we were receiving from the LP, and we had to amend my Darwin because it just got obliterated and it wasn't true to what the MetaTrader account was. Don't know why the glitch was there, but basically, as silver hit all-time highs, and this is something that I've heard through the grapevine, as silver hit all-time highs, the liquidity providers, not just LPs that we use, but in general, were getting a little bit shaky and were scared to quote to quote prices on silver. And I actually had this conversation pre-Friday, so I knew that this was in the air, right? The fact that the LPs were kind of worried because something was happening. And then later, what happens on the day is Trump announces China tariffs again, or at least hints towards China tariffs again, and market goes. So I feel some type of way about the crash that happened last week, because I feel like a lot of people got hurt, but a lot of people knew. And I don't think that's right, regardless of which market you're in. And yeah, it's not nice to see. What's the time frame to get your risk back to what it was? Does it take weeks? Still at 0.67%. I'm presuming you mean value at risk tail. Time frame to get your risk back to what it was. Yeah, jog my memory. What are you referring to there? You're referring to your value at risk. Risk 1%. I only make 2 to 3% max monthly on my Darwin, so unlikely I will reach high when I eventually make it into gold. But will it make it hard to get investors? Absolutely no way. It won't make it hard to get investors. 2 to 3% a month is fantastic. So don't put yourself down on that. I mean, if we look at mine, for example, mine's very sporadic, so mine's less consistent. Ignore April, because I traded like one day in April. So the majority of my return comes from May and September. The other months are 2, 3, 1. So I wouldn't be too concerned about, like, if you're consistent, I wouldn't be too concerned about that. To get investors, 2-3% per month is fantastic. If you can sustain that, like, I wouldn't even be worried about that. When you say reach high, I'm presuming you mean in the Darwin Gold leaderboard. So let's take a look. Darwin Gold. On my life, 16%. I'm telling you now, some people have absolutely slaughtered it. I'm not saying these people have, but on the recent gold rally, I wouldn't be surprised if we've seen like anybody who's just been buying gold. Where's gold? I don't even think I got it on it. There we are. Anybody who's just been buying gold over the past couple of months. I mean, that just looks, that's just incredible, right? Like, unbelievable. But anybody who's been buying gold on here has just been making new high after new high after new high. So I wouldn't be surprised if some of these top traders have just been buying gold. But you know, we've got 417 traders in gold, and we're already at 3% a month in the top 50, 2% top 70. So again, I think you're putting yourself down there. I think you'll do absolutely fine. You'll reach the heights and you'll be fine getting your investors anyway, as long as you're consistent. Darwin risk. Okay. Ray said, how we doing, Ray? I think he's talking about risk multiplier. Yeah. Okay, cool. Mine is 3.3. What time for? So the risk engine takes a 6-month average and a 45-day average. So what it will do is it will look at your trading behavior for a 45-day period and then compare it to a 6-month period, and it will ensure that it's consistent between the two of those periods. So sometimes I usually say you can notice a difference after a few weeks because your 45-day average will begin to change. But if you're doing it slowly, it will take a long time to catch up initially. But then after a few weeks, it will start to catch up very quick as your average curve kind of comes back in sync, if that makes sense. Can you drop me your ticker, Tail, the one that you're talking about? I know you've got them on Discord, but I I can't remember the last time we spoke on Discord. Let me see if I can find it. Tell. WXBY. Cool. Cure. WXBY. You got punished so bad for not trading a while. What with your... You got punished in what sense? Okay, so your value at risk hasn't really changed. The good thing is it's pretty consistent. More recently, it's come down from, I mean, probably dropped by 30%, but you see it's still taking into account the max and the minimum. So that's kind of the average. So as that contracts and starts to move down with the actual monthly value at risk, then you'll notice your risk multiplier start to increase. But you can see ever since the start, you've pretty much been consistent with your risk. The other one is fine. That's not a problem. It's 4 months already. Your maximum adverse excursion is huge, dude. Does this use grids at all or martingale? I presume so, because this looks quite gritty. Yeah, just keep going, but just maybe drop your risks even more slightly if you want your risk multiplier to be higher. But again, don't lose sleep over that. It's not something that's gonna change it completely for you. I often say, as you're probably aware, Tail, like people get caught chasing the tail trying to get a 1-to-1 risk multiplier, and it's not going to benefit you. So don't lose sleep. Don't lose sleep by trying to do that. Where are you in the? What's your other Darwin? Tail. XXBI. I knew I had it somewhere. Generating motion, welcome. Yes, we do allow EA trading. There's no restrictions on how you trade. The only thing I'll say is if you're trading with an EA, if it's an EA that you bought from MQL Marketplace, for example, it's highly likely that somebody else will be using it, and therefore you'll run into correlation issues. If it's fully customized and coded by yourself, then you shouldn't have an issue. For example, my portfolio is all strategies that I built, and therefore nobody else has access to. If it's like that, absolutely fine. If not, just be aware that you might run into some correlation issues. XXBI, yeah, that's doing well this month. 1, 2, 3, 4, 5, 6, 7. So you should hit gold early next year. 84th, you've taken over me this month. Nice work. Right, if you have time, weaknesses in my strategy, JCar. Let's take a look. Dude's in gold. You should be analyzing me. 23% return, 5% drawdown, solid. Equity curve looks super stable. I wouldn't even class this as a drawdown, more of a period of stagnation. It's actually something that I wrote an article on this a few weeks back, or at least part of an article. I think I posted it on X as well, and I felt when I was writing it like more people should understand and know this, but there's a difference between drawdown and stagnation. And we shouldn't fear stagnation. Like people would say, oh, I'm in a drawdown, yada, yada. But you're never always going to be hitting all-time highs. So technically you're always going to be in a drawdown, right? But I like to think of how do I turn a drawdown into a period of stagnation, which is just where the growth is slower or the growth isn't, trending in the right direction as opposed to being in drawdown. And it's slightly different because I would class from here to there as a drawdown because that's when you're kind of losing. Whereas here to here is a period of stagnation. And it's important to know how long your average periods of stagnation are and how long your max period of stagnation is, as well as your drawdowns, of course. But people tend to ignore the stagnation because they feel like oh, I'm out of drawdown, now I'm in profit again, or now back into drawdown, which is a really dangerous way to think about it, because like I say, you're always going to be in drawdown unless you're making a new high on every single trade, which, you know, most traders aren't going to be doing that. So you're always going to feel like you're in drawdown, when in reality, you're just in a period of stagnation, which is absolutely fine. There's nothing wrong with that. If you made 10% last month, and you go through 2 months of making 0.5%, then losing 1%, that's fine. That's nothing to fear, right? Because you made 10% 2 months ago, and you might make 10% next month, for example. So yeah, that's kind of bit of a side note. XAQP will bounce back. It's like a slingshot. Yeah, I mean, we're at my average drawdown. So I'm hoping that we get a good couple of trades to kind of bounce back for the end of the week. But this is why I designed the portfolio, so that I don't have to worry about it, because you know, yes, sometimes all the strategies lose together, but again, on my period of stagnation, rather than being in drawdown, I'm just in a period of stagnation, and we will likely hit new highs again when all my strategies align. It's absolutely fine. And I also know that the maximum my drawdown can get to, based on historic data, is roughly about 8%, maybe 9%. Of course, that can always be exceeded, but that's roughly what we're looking. It's roughly what we're looking at. So I know that things can get worse than they are now, but I also know that I should still be secured in gold, as long as I don't hit the max, like 9% drawdown right now, and then I'd have to make more return because of the 2.5x. In fact, would I? 2, 9, 18. I'd probably have to make about 25% return. But anyway, the point is, gold is pretty much secured. Risk 1% said, I had closed exposure to down my GJ shorts trade. Is it a bad thing? It's absolutely not a bad thing. The only reason your exposure would be closed is if your deleverage exceeds a certain threshold within a certain time period. So we do have an article on this that explains why the risk engine will intervene, but essentially it intervenes at 2 different times. When you open the trade, it will not necessarily intervene, but it will get involved. It will calculate the right position size that your Darwin needs to open, and then it will monitor the deleverage, which effectively is your exposure on that position throughout the lifetime of that trade. And if it exceeds the threshold, it will then begin to shave off a portion of that trade to keep the value of risk stable. It can do this based on time increased exposure. It can do it based on the volatility of the asset increasing. So last week, again, we had a lot of people who were saying, oh, I've just had exposure closed. Of course, the market, the VIX increased, the market volatility increased in general, and therefore the assets were moving higher, like the ATR was wider than normal. So what people were seeing was the risk engine was intervening, shaving off some of their position sizes just to keep their value at risk stable. Account ready the 20th. Fantastic. I'm excited to see that, dude. That was to tail. Okay, so let's take a look. Congratulations on your... Oh, congratulations, dude. 7 investors, $180,000 in investment in investor capital. That's fantastic. I mean, that's a solid jump. You had your first investor with 12.8K, and then 9th of October. So less than a week ago, you shot from 12K to 180.4. Well, it's 183 at the moment. I'm curious, is any of that Darwinex Labs? I'm presuming some of that is from Darwinex Labs. Probably not the index yet, but most likely Darwinex Labs. 8, 4, 5, 6, 7, 8. I also presume that you went into gold this month. I'm guessing. I'm making an assumption. I presume you hit gold this month, and I'm presuming that one of these investors is Darwinex Labs. Yeah. Cool. So for those of you that don't know, we have the index, which is our hedge fund, which is where we're raising capital and trying to allocate as much to our traders as possible. But we also have our in-house prop fund as well, which is called Darwinex Labs. Now, this is, I think we have about $11 million of our own capital invested into our traders. We run it at a little bit more of a high risk portfolio than the index, but it's for internal use only. We don't have external investors in that. The reason is twofold. A, we want to capitalize and monetize our top trading talent. So again, it's just another stream of capital coming to our traders. But secondly, it's sort of a test before they get included into the index. So what traders usually see is before their index allocation, they're allocated capital from the Darwinex Labs fund. And then based on how the trader acts based on how the trader manages that capital and acts under the additional pressure of having, investor capital under management, we will then tick off another few boxes and move them to the index. Okay, so Ray has both index and labs. Oh, interesting. So we're taking advantage of you from both sides then. Could you explain how someone would pick JCar if no one had invested in before? Not trying to be mean, just how someone picks a strategy to invest in. So I would presume, and Ray can correct me if I'm wrong, I would presume that first 12K was from Darwinex Labs. I could be completely wrong, but what we're trying to do is get as many Darwins that come through gold an allocation in Darwinex Labs as quickly as possible. Reason being is because we want our traders to get that capital ASAP, of course, but also it combats that whole like sheep effect. Okay, so Ray confirmed, right? So what we noticed, especially with THA back in 2 years ago, even a year ago, right, before we launched index, capital would, to put it blunt, investors are like sheep. They will go somewhere that they feel comfortable, safe. In fact, David Bell, if nobody knows David Bell, he's done a fantastic few posts and videos about this sort of topic and about how, for example, British people are scared to invest, or there's no culture to invest. And it's the same kind of thing, right? Is people are scared to put their money what they deem as higher risk. Now, that's not saying that THA is lower risk than JCar, for example, but the majority of investors, if they compare side by side and they see THA is managing 20 million or 30 million or 40 million, however much it is, and JCar is managing nothing, they're going to go, well, I'm not going to be the one who allocates capital to JCar. I'm not going to be the one who, sits on my own and is the only investor there. I'm going to go and join the other 20 million over at THA because I feel comfort in the fact that this guy has another 1,000 investors. It's just the way people think. It's basic human psychology, right? Is that there's a sense of comfort knowing that other people are kind of in it with you. There's no worse feeling than losing money on an investment and being the only one who has, right? Because you look at yourself and then you look at everybody else and you go, well, why didn't I do the same thing as everybody else? And that mentality is what forces investors to look for. So to go back to your question without going too much on a tangent, Tal, so it's possible to, I'm presuming that you mean never have investors. It is possible to never have investors, but you would have to have some zigzaggy performance. But essentially, we launched labs and index to overcome that and to spread the capital more fairly, or distribute the capital in a more meritocratic approach. Because, and this isn't me being disrespectful to THA, but over the past couple of years, there's been Darwins that have way outperformed THA from strictly a performance perspective. For example, ERQ has just been on absolute fire. I'll bring him up so you can see. But traders weren't investing in ERQ; they kept investing in THA. And again, it's more so the idea of being safe with everybody else, right? Now, if we look at this, ERQ is just absolutely fantastic, and it's great that it's funny because ERQ specifically puts a block on how much investment that they want to take. So he kept capping it at like 3 million, 2 million, 4 million. And we had to keep asking him to increase his limit so that we could allocate more capital because the strategy is so fantastic. So that's why you can see over here, it was kind of like he'd set the limit in so we could never get past it. And then we've kind of convinced him over time to let us allocate more capital. Hence why he's now sat at about 6 million. I actually didn't know he'd surpass 6 million. So that's fantastic to see. But you can see this year he's done 14%. Last 2 years have been relatively slow, like not fantastic years, but still positive nonetheless. But if we look at THA, less than 1% this year, 4% last year, and 13% the year before. I mean, granted, that was better than ERQ. but like ERQs come back this year. I mean, to be fair, we're starting to see the switch anyway. If we look at THA from the peak, I think he was managing 38 million at his peak, and now it's dropped right down to 18 million. I put that down to two things. One, the index, but also some of the talent that's coming through Darwinex Zero, as I mentioned earlier. Like, we are seeing investors move because there's capital being spread more fairly. Let's use the word. Again, investors are feeling more secure and happy to allocate to other traders as opposed to just THA. Don't forget the underdog XAQP is better than THA. Well, this is it, dude. This is it. XAQP, yeah, is my baby. Although, and sorry, Ray, we will get back to JK in a moment. BYXB is my other baby that's been doing really well recently as well. It trades the same strategies as XAQP, but it also has a carry trade grid system running as well, hence why the drawdowns are a little bit harsher. But I've changed the way that it grids into the carry trade system since then to avoid these sorts of massive drop-offs. As you can see, it's been way more consistent over this time. I think I made the change about here. Yeah, it was about mid-August. Essentially, I changed the grid to be much higher time frame and to grid into positive swaps only. So every trade that I'm sat in, even if in drawdown, some of them are paying themselves before they've even hit target because of the swap fees accumulating. What's the minimum investment again if I wanted to invest into XAQP or JCAR? Oh, it's a great question. I don't think there is a minimum. I don't think there. Right, the minimum is 1 million. I mean, I wish. I don't think there is a minimum. I've seen Darwin's with like $250. I think it would just be a minimum of how much you can invest into the broker. Darwinex.com. Let's take a look. Oh no, this is my other account. I don't know if it's going to say here. I mean, I should know this off the top of my head, but here we go. 200. So $200 is the minimum, or $200, euros, pounds, whichever currency you use. I thought 100, maybe 400. It's different for if you're a trader to if you're an investor, because we know, of course, investors, like if you're an investor and you deposited 10 grand, you might split that up, into 10 or 20 different Darwins, and therefore we obviously lower the investment amount per Darwin. But looks like 200 is the minimum. Whereas if you're opening a brokerage account to trade with, the minimum deposit is 500 to open the account to be included in Darwinia. It's $1,000, euros or pounds. But we always say, well, we don't always say because we can't advise on this due to regulation. But it's always advisable that if you're trading with the live account, to keep the equity above 1,500, because if you go on a losing streak and you drop below $1,000, pounds or euros, then you might lose access to Darwinia allocations. Okay, back to JCAR. Oh, Sharp ratio. That's that's naff. That's way too high. The problem with sharp ratios and stuff like this is when you have such a condensed data set, like you performed fantastically over the past 9 months, but 9 months isn't a massive amount of time. So if you go on a drawdown now for the next quarter and you lose 5% and another 2%, that sharp ratio is going to come right down. So 4 is like out of this world, sort of, God league. I'm not saying that you're not out of this world in God league, but it's likely that that's overinflated just due to lack of data. I think mine was like 8 at one point, which I know is absolutely not right. Okay, assets and timeframes. Let's take a look. If it ever wants to load. Okay, so your main asset is FX. Do a little bit of indices trading. So we've got 162 trades, 7 of which are on indices. you actually have a fantastic win rate on indices, but it's just not enough trades again to kind of make a judgment on that. I'm presuming you're more of a position trader or swing trader as opposed to anything else, potentially a day trader, but you don't trade every day, just based on how many trades you have. Fantastic win rate, 78%. Interested to see what your average risk to reward is. Okay, so you got a negative risk to reward of 0.5 R with a win rate of 78%. So if you haven't seen this before, this is a fantastic, not sustainable day swing. Okay, yeah, that's what I thought. So this is a fantastic table to understand what your expectancy can be over a 50 trade period. So this effectively shows you the probability of seeing at least X amount of consecutive losing trades within a 50 trade period. So percentages down the left and the amount of losing trades in a row is above the top. So this is over a 50 trade period. So at 78%, I'd say we're more towards 80. So let's just round it up to 80% win rate. There's an 86% chance that you'll see 2 losing trades in a row. There's a 32% chance you'll see 3 losing trades in a row. And then you can see at 4 and 5 and 6, the percentage chance drops down massively. So there's a 7.2% chance that you'll see 4 losing trades in a row. And then it drops down to 1.5% chance, which means there's a 98.5% chance that you're not going to take 5 losing trades in a row within 50 trade period. So that means if over the next 50 trades, there's a 98.5% chance that you won't take 5 losing trades in a row, which is really good because you can understand, like if you've got 4 losing trades and your setup comes for the next one and you're feeling a little bit itchy and like you don't want to take that 5th trade, well, then you refer back to this and we say, well, my win rate is roughly about 80%. You know, and so there's only a 1.5% chance that I'm going to see 5 consecutive losing trades in a row. And even though each individual trade has its own, 50-50 probability basically of being right or wrong, the fact that you've seen 4 losing trades in a row with the win rate that you have, it's very unlikely to see that 5th trade. So what I would do is I'm going to leave this up for an extra couple of seconds. If you haven't seen this before, take a screenshot of the screen now. Don't kick me in it. You can cut me out of your screenshot. But I think it's super important that every trader sees this and understands what it is, because it's a really great thing to refer back to, especially when you're going through a period of losing trades. Let's move back across. Payoff ratio 0.52. I actually quite like that. I have systems that do the same. You just have to absolutely be on your game at all times, because you have a negative risk to reward or a lower than 1 risk to reward. Basically, for those who are unaware what this means, although I'm presuming pretty much everybody knows what it means, is you lose 1 on your losing trades, but you only gain 0.52 on your winning trades on average. So like I say, it's absolutely imperative that you keep up this win rate. You can't let it slip. You can't have a bad day. With that in mind, you have a phenomenal profit factor of 1.9. If you're not aware of how profit factors calculate, it's basically the sum of all winning trades minus sum of all losing trades. I don't know if it takes commissions and swaps and stuff like that into account. I'm presuming it does, but 1.9 is fantastic. Again, anything above 2 is like out of this world. Let's go back to assets and timeframes because I kind of got sidetracked then because I was looking at your win rate. So you trade a lot of different assets, right? I mean, it's pretty clear to me that you've got a few assets that you can focus on, like euro dollar, euro yen. I would be dropping pretty much everything and just trying to become a master on a few of these. Like even these, yeah, there's a positive return, but does it warrant the additional risk or should you just scale up these? This is kind of a decision that you have to make. I prefer to have as little time in the market to generate as high a return as possible. You're kind of at the point now where you can begin to make changes because you have enough data and enough time about to kind of make decisions. I would be looking at this and being like, where am I least efficient and where am I most efficient? It's clear that you're least efficient trading Aussie dollar. You should definitely stop trading Aussie dollar. Like that's and well, not definitely, but I would be looking at this saying there's no reason for me to trade Aussie dollar. It's my second most traded asset. I've got a lower than average win rate compared to my other pairs, and I've lost money over it over the past 9 months. I wouldn't be looking to continue to trade that. Not when you look at euro dollar, when you have a much higher win rate and a much higher return. I would potentially be looking like. I look at this. I don't go, oh, well, I'm removing Aussie dollar. Therefore, that 1.66% return is gone, yada, yada, yada. I'd be looking to redistribute this risk out. So the risk that you're providing to Aussie dollar, look at reallocating it out to euro dollar or euro yen. Euro yen is massive, right? So these two are kind of perfect because there's 3 trades between the two. So you've had 26 trades on Aussie dollar and 23 trades on euro yen. Your win rate on Aussie dollar is 69%. Your win rate on euro yen is 82.61%. I can already tell you before we look at the return, the expected value of these is going to be different. Okay. So we're looking at 69% win rate with a negative return, or an 82% win rate with a plus 10% return. Now, when I'm looking at these, what I'm asking myself is, which asset do I have the highest expected value on? It's clear it's euro yen, right? Because trades divided by return, or return divided by trades, per trade, your return is far higher, and therefore you have a higher expected value on those positions. Now, I'm not saying you have to drop Aussie US, because that might go through a winning streak now, bring that back up, and you might go on a losing streak on euro yen. But I would try and identify why there's a discrepancy. Are you doing something different on Aussie dollar that you're doing on euro yen? If so, that's fine, but understand why you're doing something different. Is it asset specific? For example, does euro yen do something specific that Aussie dollar doesn't do, and vice versa? Are you trying to implement the same pattern or technique on both assets? Because cross assets, do different things. In terms of the Nasdaq is going to behave differently to the euro dollar. Of course, because the Nasdaq is an asset that is designed inherently to increase in value over time as the economy grows. And company value grows. Of course, the Nasdaq is going to increase with that. Same with the S&P, for example. Euro dollar isn't designed in that way, and therefore those markets move completely independent of one another. And you can't just learn a basic chart pattern. And I'm not saying this to you, Ray. I'm just saying in general, you can't learn a basic chart pattern and go, well, I've learned how to trade euro dollar. Now I'm going to go and implement it on all of these other assets, because it's not going to work. Okay, every asset moves in different ways. Different economies have different key influential speakers and different drivers for the economies. Even when you look at something like the US compared to an economy like Switzerland, for example, the economies are completely different. They have different reserves back in their currencies. Like, there's so much different in the background. Yet a lot of traders will generalize them as the same thing, because when you load up a USD Swiss chart or a Euro Swissy chart, they're the same thing on the screen, right? They're just both a candlestick chart, but behind those candlestick charts, there's 1,000,001 different variables that are all pointing in different directions. So I'm a massive fan of looking at what assets I trade well, what assets I don't trade well, and not just me, but the traders that I work with through Darwinex, and knowing where you should put your foot down on the gas. I'm not a believer in the fact that all assets are created equal. I think some traders get a flow for a specific asset better than others. And some strategies are designed better for certain strategies. Like, you could implement a long only strategy on US equities and do fairly well. You employ the same long only strategy again on euro dollar or pound dollar, you're probably not going to do so well. Okay, because it's not designed to increase over time the same way that the indices are. So super important to take a think about. I'd be looking to essentially do less work for more reward moving forward. What I would say is try and do some simulations on this. So try and do some. This is actually something that I'm building right now, which I'll give you a little bit of a sneak peek into. Let's pull this across. So it was something I was building for myself. So there's not many trade journals that are great for algo traders, in my opinion. There's a lot of features missing that algo traders might want. So I decided to build one for myself for internal use. And then going through it, I'm like, this is pretty cool. So maybe I'll commercialize it. I don't know. But one of the things that I built, which I use a lot, is a Monte Carlo test. So basically, what a Monte Carlo test does is it takes a look at your data and basically gives you random outputs on a trade-by-trade basis. This way, you know that your strategy over a specific period of time, how it's going to perform even without random outcomes. So what I would be doing if I was you is running some Monte Carlo tests. You can do it with more simulations. And of course, there's different softwares out there that help you do this. So you can see this is XAQP, for example. So you can see over the 401 trades XAQP has done so far, or even the worst case has a positive expectancy on 100 simulations, okay, which is fantastic to know. I'm about 50%. My actual results are about 50% of best case and worst case. But I would start running Monte Carlo tests for your strategy as a whole. So you can do this by, I mean, the way I would do this with this is download my data from MetaTrader, run the Monte Carlos as a whole. You can do this on like Quant Analyzer and stuff as well. Then I would omit some of the assets. So omit some of the assets that you don't want to take forward. Run a Monte Carlo on that as well, and see which ones are have less variance. So you should always look at the confidence levels as well to ensure that basically there's not a huge variance between the max drawdown and the return of your results, worst case and best case. Okay. And if you find that there's tighter variance when you remove 10 different assets, you know that you're going to have a more stable performance moving forward. However, I might be talking a load of nonsense here. Who am I to say that I'm right in this scenario? You might run the Monte Carlo on your portfolio of assets as a whole without omitting any, and find that the variance is way less, and it actually benefits you having, it might even benefit you having Aussie dollar as an example. Yes, it might be a losing asset overall, but actually what it might do is when you lose on euro yen and euro dollar, you actually win on Aussie dollar. So even though it's negative overall, you're hedging against your losing trades on euro dollar and euro yen. This is all hypothetical, right? So I'm giving you hypothetical situations here. You might be looking at me going, well, this doesn't apply to me, and that's absolutely fine. But it's just something to think about. It's just something to understand. Again, yeah, that's something I'm building at the moment. I'm happy to give people beta access once it's ready. So I think, I mean, there's trading journals out there, right? But I'm trying to build one that has everything that I need. And I'm big into data, so I like all of that sort of stuff. And maybe I'll integrate some of these Darwinex things in there with feedback. So in fact, that could be a great idea. I might integrate our metrics and basically make the strategy development sessions that I do. I might try and build that into the journal so that you can good idea to me. That's something I need to chase up, actually, Tal. Dr. Snow Cream. Yeah, she's sat on guard at the bottom of the stairs. I'm never going to be able to stop her barking. She's a Rottweiler. That's what they do. I just have to sit there and just let her get on with it. When am I building my tribe on Darwinex? I need to chase up on that, actually. I think I got the green light. I'm working with Joanne, who's our Spanish business development representative, because we wanted to do some English first Spanish tribe league sort of thing. The problem is, of course, over the past couple of weeks, they've just been completely off schedule and stuff. So haven't been able to do much on that end. But I will chase that up this week and see if we can get it going. Risk 1%. Can people in silver get investors or gold only? It's gold only in Darwinex Zero. If you trade in a live account through Darwinex, then it doesn't matter whether you're in silver or gold. You will be able to get investor capital. Also, if you go into gold and then later down the line you move back to silver, if your performance drops, you will still be open to investors. As soon as you've hit that initial benchmark or requirement for gold, you will always be open to investors moving forward. Train time distribution. I've actually become less of a fan over this. every time I talk about it, purely based on the fact that we don't know whether you can't decipher whether you closed or opened a trade at that specific time, which I think is a really important variable that you have to be aware of in here, because we don't know, this, for example, where you've got 12% of your trades, is that 12% where you executed or 12% of your trades where you closed? And without knowing that information, it's really difficult to make an assumption based on these figures. I used to think it wasn't too bad, but the more I think about it now, I don't think we can make any assumptions from that. Return distribution by day of the week. This is also one of my favorite ones. I won't go into all my examples that I usually do when I talk about this, because the guys who come to these sessions again and again and again will know that I bang on about the same examples of this, about the guy at the pub and the mum dropping the daughter to school. So I'm not going to bang on those examples again. But what I like to do here is not just looking at the edge and where the edge performs or what day the edge performs better on, but look at what you do on a day-to-day basis as a trader. Specifically, if you're a discretionary trader, you need to understand where you perform best, how you perform best, why you perform best. So, for example, if you notice that, let's say Friday is your worst day. I mean, it's not by far. There's not much variance between your these 3 days. But let's say Friday was really poor compared to the other days, and you realize Friday is the only day of the week that you go and work in an office, and the rest of the week you work from home, and therefore your performance is better. Well, you know that environment is probably contributing to some of your performance on those days, and therefore when you're working now out of the office, or you're not at your usual setup or your desk, you know that maybe you should take your foot off the gas slightly. Again, there's not much variance for you. I don't think there's anything really here that stands out to me. Again, it's kind of like the Monte Carlo, right? It's kind of like looking at this chart. How random is it? And I don't think yours is very random, because they're all pointing to the same direction. The key thing is identifying outliers where you go, yeah, that is significantly better than that. For example, your best day is 6.8, your worst day is 1.95. It's a bit of a variance, it's like 5% almost, but it's nothing crazy, because if you had one losing trade on a Monday and one winning trade on a Friday, that gap's going to be closed to like 3%. Okay. And therefore it comes in line with all of the other averages. Maybe it's worth, I think maybe I might speak to the team and see if we can get an average line as well. Like a white dotted line maybe that shows kind of the average return, because that'd be really good to know the days where you perform above the average and the days where you perform below the average. And then at least you can curate some of your routine / ideas based on the average. I'm a big fan, especially again, for the guys who've been coming to these sessions for, I'm not just talking weeks, but for months. They would have seen a change in me as I got more into building portfolios and stuff. I'm obsessed with averages, understanding what is likely to happen. Okay, even with randomized outcomes, what is the average? What's likely to happen? Are we above or below that? Okay, because there's likely going to be a mean reversion at some point. If my performance is way above the mean, which has been recently, I know that it's likely going to come back down to the average. And therefore, I'm not surprised when a drawdown comes or when a period of stagnation comes. And the same on the other side. If you're performing well below average, like I have been today, well, guess what? Coming into tomorrow, I know that there's a higher chance tomorrow that I'm going to have a couple of good trades, because I'm performing below the mean at the moment. So I think it's something really important, actually. It's a conversation I'm going to have. Can't promise it will get added, but I think it's definitely something useful that we could add on here. London is my best session, which is 1 to 4 a.m. your time. Lol. Need to set more stops and limits. I'm presuming you're US based. 1 to 4 your time. No, that can't be. You can't be US based. Are you? What time zone is that? Because US would be. Yeah, I don't know. Time zones KO me. Oh no, it could be US based. I'm sure you'll confirm anyway, Ray. PST. Right. Okay, so it's US. Let's take a look at your maximum excursion. Yes, it is. Okay, so I've spoken about this before. I don't mean this with any disrespect, Ray, at all. I'm not a massive fan when one candle on your excursion chart is an outlier, because again, going back to my point is I love averages, right? I like being able to anticipate what happens next, and maybe it's a personal thing, but this euro yen position here took 4.71%. So that's half of, if we go back to this, filter down by asset, euro yen was your pretty much your top asset, but half of that return come from one trade. Okay, so we can say one of these 23 trades was a bit of an outlier, a bit of a red herring, but it contributed to 50% of the return. So again, when thinking about randomized outcomes, what if that trade didn't happen? What if that 5% trade on euro yen didn't happen? Well, we'd have 22 trades with a 5% return. That changes the expected value dramatically. And that's the reason why I'm not a massive fan of when we have one massive spike to the upside, because I feel like it skews a lot of the other data sets, because like I say, 5% of your return come from one trade, and there's nothing wrong with that. You took the trade, you took the winner, fantastic, great work. But it's something to be aware of, because if we're looking at your assets, for example, and making a decision on what to do based on the data that we have to understand, okay, well, what's behind that data? Why was euro yen such an outlier? Because it's actually not that much of an outlier. It's this one specific trade that is, but there's 22 other trades that, weren't crazy, if that makes sense. I mean, if you can justify why that trade ran so hard, of course, fantastic. Again, who am I to say that you shouldn't be in that trade? But what I prefer more is knowing on average how far do trades go for you, because it's easier to figure out your next steps. If you know on average these trades move for me 50 pips, well, great. We can start making sure our targets fulfill that 50 pip region. Whereas if you say, well, my average is 50 pips, but then I've got these two trades that ran for 5,429 pips, we go, well, you can't really judge all of your trading history based on these two trades, because they're the outliers, right? In fact, this was an interesting conversation that I was having earlier today. We were talking about trading influencers. Actually, it's funny. I was talking to one of my friends, and I was saying everybody idolizes the unicorn, right? Everybody looks at the one person who's made multiple millions in a short period of time, and they go, that could be me. If only I stick to this, I'm going to be that person. And sometimes you have to have a bit of reality and go, well, what's the average? What does 99% of the bell curve get? They might make 10 grand a year, 15 grand a year, 50, 100 grand a year, but they don't make 2.5 million in a single payout from a funding company or from Darwinex, for example. And so you have to manage your expectations. Now, relating this back to this, it's the same thing. I would be going into every trade looking at the average of all of these other trades, understanding how much of a market move I usually get. So when I get into a trade, the market generally goes, 50 pips in my direction before reversing. That's how much I can expect on a winning position, not 5%. Yes, we look at this and we go, well, my best positive excursion is 5%. So it's clear I can get big moves. Well, it's only happened once. Okay. So this is a bit of an outlier. So where's that average? Okay. 0.34%. How much is that of this? Like a tenth. Okay. I mean, I'm rambling on a bit much about that now. But you get what I mean, I'm presuming. I like with the adverse excursion, it's pretty much, there's a few outliers. We've got this position here, these couple over here, but they're not too far past the average. Again, your average is a tenth of your worst, but I wouldn't be too concerned about that. What I would look into, however, if I can get my pen up, running some simulations on this. This might take some more manual work, but finding your average. Okay, so your average is actually up here 0.24, but I would give yourself a little bit more flexibility. I would be looking at a line like this, let's say, and I would go, what's my expectancy if I was to cut off all of the trades at that point? Okay, of course, you've got to figure out what this is when it comes to pips or points. It's a little bit more difficult when we're looking at percentages. But if I can cut off my trade, so this is kind of the max stop out here. Do I save enough on these positions with this candle here, this candle here, this, all of this here? Do I still have a similar win rate? Do I save enough R there that is worthwhile me implementing a fixed stop on these positions? That's something that I always try and look to do, is capping the downside. Because let me clear it off now. If we look back at this line, is all of this didn't need to happen, right? So if we look at this specific example on this trade, you took a loser. So you closed it out at the bottom. Okay, well, what if we'd cap the risk to here? Because we know generally when we cross this threshold, we don't win the positions. I think you won that one, so that's an outlier. That was a loser, loser, loser. All of these pretty much, apart from, oh no, that doesn't count. They're losers. This one's a loser, loser, and then maybe another outlier there. Okay, so we say, well, if we'd have cut the risk on these two positions, 1 and 2, we wouldn't have won those trades. So we'd have taken 2 extra losers, okay, out of these positions. However, we'd have saved this much, and this comes to money, right? This much, this much, this much, this much. All of this would have saved these. Okay. So let's say you lose that much profit, right, based on 2 trades. I know that's an awful drawing. I do apologize, but you save this much losses. Oh my life. What? Nah, that's embarrassing. Can't be showing that. You save all of that drawdown from 10 different trades. Is the drawdown bigger than the profit that you would have won from these 2 trades? If so, try implementing a fixed risk. And I don't mean fixed risk of increasing all of these bars, so like increasing the risk on all of your positions. I just mean capping it at a certain level. So if you go into X amount of drawdown, you then cut all the trades and cut all the positions. Let's clear it all. Control Alt Delete and get rid of Epic Pen. For some reason, it's one of these programs that you can't close down. Oh crap! There we go. Value at risk, super stable. Really nice to see. You had a bit of variance over here, but then it quickly got shut back down again. It's been increasing slightly. Where's the low? The low is probably somewhere around there. Almost 2x of the low of your value at risk, which I would presume has probably knocked your risk multiplier to currently maybe 0.8%, 0.7, 0.8x, sorry, not percent, with a 10.45 risk multiplier. But the main thing here is consistency. I don't care whether it's high, low, fat, thin, I don't care. As long as it's consistent. The only time I care about value at risk is if it's above 30%. If it's above 30%, there's an exponentially higher risk of you blowing an account or going through a significant period of drawdown. Now, what I mean by that is, I'm bringing Epic Pen up again, even though I've just closed it down. So let's say, because I feel like I haven't always explained this well. Let's say there's actually, no. So let's say your value at risk is 1, 5, 10, 20, 30, 40 plus. Okay, and then this is risk of blowing account. Honestly, I bet no one can even read that. So this axis on the left is risk of blowing account, and this is your value at risk. Okay, can we change color? Now, how it goes is like this. So the risk of blowing your account increases ever so slightly. So obviously, the higher your value at risk, the more risk there is of you blowing your account. As you surpass 30, the risk of blowing your account exponentially increases like that. So what I tend to say is, if you're below 30, this is kind of a safe zone here. It's not to say that you won't blow your account, because there is always that chance. Or when I say blow your account, I also mean go into a massive drawdown that you can basically not recover from. As soon as you surpass, ooh, what have I done there? As soon as you surpass that bit, that section, as soon as you pass the value at risk of 30, this begins to increase exponentially to the point where you're pretty much eventually, whether it's 2 months, 2 years, 20 years from now, you're pretty much guaranteed to blow your account. Oh, gosh. Let's remove all of that. I think we are done. Oh, my God. Why can't I do that? Epic pen. Let's close you down, bad boy. I hope that all made sense. I kind of went over some stuff today that we've never been over in the strategy development sessions. So I hope I didn't ramble on too much about random things, and that you actually understood some of the things I was talking about, because I have this annoying habit of, which I'm doing right now, going off track and just rambling on about random things and not sticking to the actual point of the conversation. Which I guess is what's great about these sessions, right? Is I can just come on and just talk and talk and talk. But I hope I provided some insights to you, Ray. I mean, fantastic job anyway. You're super consistent. You're in gold. Like, you're already doing really, really well. I don't think there's anything to be concerned about or anything that you need to specifically do. There's, of course, some refinements that you can make, and you can look at where you perform best, where you don't perform very well, and, you know, kind of push your foot down on the gas when you highlight where your expected value is highest. But all in all, I mean, I'd be pretty proud of this myself. If you can get to, we can't count Jan. Yeah, you started on the 31st of Jan, hence why you got 0% return. So, I mean, if you can get to 25 to 30% by next January and have yourself 30% year, you can see your annualized return is actually 34%. Like, that's fantastic. 34% annualized return with a max DD of 5% is like your creme de la creme, cream of the crop sort of thing. So yeah, I mean, absolutely fantastic, Darwin. I'm going to bookmark it as well. JCar Ray. I bookmark it so I can keep an eye on how you're doing, because especially when I do these sessions, I feel like I have a vested interest in all of our traders succeeding and doing well. But when I've spent time going over it and like talking about Darwin's, I always like to check back in a couple of weeks or a couple of months and see how they're performing. Maybe some of the things that I talk about, you do implement, maybe some that you don't, but I still have an interest in seeing all of you guys succeed anyway. Ray got promoted. You're promoted to Darwin's on watch. Appreciate all of the insights. Great value. Thanks. Pleasure, Ray. You know, these sessions wouldn't be anything without you guys. Thank you. Great insight for Darwinex newbie. Awesome. If you're a Darwinex newbie, I highly recommend. I'm not even going to try and pronounce your name. I'm presuming you're Polish. Please don't kill me if I'm wrong. But I'm presuming that you're Polish. The name looks Polish anyway. If you need anything, please feel free to send me a direct message on our Discord server, or drop us a direct message on any of our social media platforms. Happy to jump on a call or answer any questions that you have. Yes, Polish, got it right. But we also have some fantastic live sessions on our YouTube for beginners to Darwinex as well. If you go on the live if you go on the live tab on our YouTube and scroll down, you'll see welcome sessions, risk engine sessions, strategy development sessions, and all of that sort of good stuff. So you can spend some time watching those, understanding everything about how Darwinex works. But with that, guys, I'm going to love you and leave you all, because it's now 6:10 and I've got fajitas to go and cook. So Mexican night for me. So I hope you all have a fantastic evening, afternoon, or morning, wherever you are in the world. Have a fantastic rest of your day, and I will catch up with you all tomorrow at 4 p.m. UK time. We'll be back to do another strategy development session. Guys, have a pleasure. Have a pleasure. It's been a pleasure. Have a great rest of your day, and I'll catch you all in a bit.